This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Because capital gains tax has been simplified to a large extent insofar as we have proceeds less cost equals gain, and I know there are some quirks in the rules and regulations of how that works. Sometimes we're not given proceeds, we've got to work it out. Sometimes we don't have costs, we have to work it out. But basically it's proceeds less costs equals gain. So in exams particularly, the questions have started to include a lot of reliefs. Now, they are very important because they reduce the rate at which tax is paid. Some of them do. Some of them exempt again from tax, and some of them defer the payment. These are the main ones. So these two reduce the rate of the tax down to 10% regardless. There's no need to worry about the basic rate bands. These two defer or put off the gain and the payment, sometimes indefinitely, but they're still deferrals, and this includes exemptions, and these are the ones that we're going to look at in this chapter. Now, there's no point listening to the recording and the lecture for this chapter if you haven't done the other two, because this builds on the other two chapters, particularly the first one, where we worked out what the pro forma is, how it works, how the annual exemption is dealt with, losses, all of those things. There's no point being able to do these exemptions if you can't, and deferrals and reliefs, if you can't do the basics with capital gains tax. So if that's the case, will you please stop the recording and go back and do the other two previous chapters and make sure that you are fully aware of all the different aspects of capital gains before you come to the reliefs. So we're going to do the business asset disposal relief first. It's available to individuals who are disposing of a business or part of a business. The first £1 million of any qualifying gain that you make, and that's a lifetime limit. You only get £1 million in a lifetime. You will pay tax 10%, regardless of your income. So you could be an additional rate taxpayer paying income tax 45%. But if that's the case, you would only still pay 10% for your chargeable gains. Now, obviously, that is a massive saving for a lot of people. So there's got to be some conditions. It's really useful for a lot of people. So you must have owned it from at least 2 years. That stops you buying a business, stripping out the assets and then selling it on. Now, the relief is available for whole or part of the business. It's got to be a sole trader or a partnership. It's not available to limited companies. It's not available where you simply dispose of an asset within the business. It's got to be the business itself. It's not available on investments either. That's the main one. Now, if it's part of a business, so these are the three main ones, whole or part. Now, if it's part of a business, that part must be capable of functioning on its own. So if you sold a warehouse, it's not a business in itself, but so you couldn't get BAD relief on that because it's not capable of functioning. But say, for example, you owned 3 shoe shops and you sold one of the shoe shops, that's capable of functioning on its own. Therefore, you sold part of the business. So that's what we mean by part. So that's the first one. Whole or part of a business that you've owned for 2 years. The second one, when you cease to trade, then you could, the disposals of the assets is an allowable situation for BAD relief to take place. It's got to take place, the sale's got to take place within 3 years of ceasing to trade. The third one is disposal of shares. It must be a trading company where you have at least a 5% shareholding, and there's an and there, capital letters, an employee, part-time or full-time, for 2 years prior to disposal. So those are the 3 main areas on which you can get this relief. You must make a claim for it within 12 months of the 31st of January following the end of the tax year in which the disposal is made. So for 22-23 you've got till January 25 in order to make that claim. So let's have a look at the first example. Daisy, 30th of September, Daisy sold a business that she ran, unincorporated, tick. She sold the business, tick. She'd been in business since 2014, tick. She's fulfilled all those criteria. Whole or part of the business, it's sole trader, and she's had it for more than 2 years. Following gains and losses. So all of these are from the sale of the business. So they would all be netted off together and added into the computation. Now in January 2022, she also sold a 20% holding in an unquoted company. Now she was an employee and she'd had the shares for more than 2 years. And there's a gain on that. So she is going to get relief for that as well. So let's see how that works if we put them all into a computation. So we've got assets that we're going to claim BAD relief on. So the business, we've got the goodwill, we've got the factory, and the warehouse. Now that was a loss. Current year losses against current year gains. The shares. So every time you come across these assets, you have to ask yourselves, put those rules into place. Does this question, what's happened in this question, does that fulfill the criteria that I know in the rules? So there was a gain on the sale of the shares of 370, wasn't there? So a total of 850,000. Now what was the limit? Can you remember what the limit was? It was £1 million, wasn't it? There's nothing in the question to suggest that she's used any of it up. So she's still got another 150 that she can have in the future, should she need to do so. So all of these gains, just like we've done before, all of these are added together. We then deduct from there the annual exempt amount. And again, never guess, and we know what it is because we've been dealing with it in the previous chapters. That's the taxable, don't forget labels, taxable gains. Now, how do we know what tax that she's going to pay? Well, because all of these are eligible under the relief, then the gains of 837,700 will be taxed at 10%, which is £83,770. Further points that we need to consider. The gains qualifying for the relief must be taken into account when establishing which tax rate applies to other taxable gains in the year, because they are deemed to use up the basic rate band first. Now, in the previous chapters, you will know that we did that. We used the income tax position to work out how much basic rate band was left in order to then tax some of the gains at basic rate and some at high rate. If you've got assets that qualify for business asset disposal relief, they are deemed to use the basic rate band up first. And obviously, if you look at this question that we've just looked at, it's very clear that 837,000 is going to use up anybody's basic rate band. And that's normally the case you'll find with these things. AEA and capital losses should be deducted first against gains that are not going to qualify for business asset disposal relief, because they're going to be taxed at these higher rates. Sounds obvious, doesn't it? Okay. Once your limit has been passed, then you pay tax at the normal rates. If you're doing a question, you're going to need separate columns for this. Definitely going to need separate columns. Now, we've got an example which helps us to see how that works. Example number 2. Anna sold her business in Annie Limited for 500,000 in 22-23. So that's the proceeds. The shares had cost her that 50,000. Now, she owned more than 5%, and she'd been a full-time director. So that qualifies for BAD relief. Okay. Now, it says here that she's not used any of her relief before, so she's got her full £1 million. Now, she also had an antique painting with a gain of 100,000, so that's an ordinary one. Needs to go in a separate column. Losses brought forward of 25,000, taxable income of 18,000. So how much basic rate band has she got left? Okay, basic rate band is 37,700. That's taxable income after the personal allowance. So she's got a basic rate band left of that. Okay, always show it, because there is a but with this one, but you need to show it. It is important because you've shown the examiner, you know that what the rule is in that situation. So let's have a look at how that will look in our answer. 2 columns. You go down to the right place. There you go. 2 columns. One for those assets that qualify for the relief, and these are our other gains. So the ones that qualify for relief are the shares. Proceeds less cost equals gain. Okay. Now, what doesn't qualify is the painting. So that's in the other gain column. And as we noted in the manual itself, the AEA goes against anything that's going to be taxed at a different or a higher rate. Losses brought forward. Now, the process, the pro forma, is exactly the same all the way through these chapters. Proceeds less cost equals gain. If you've got several, you do either a little indentation or a little workings like this. You could set it up beforehand, which I would advise. Add in the bits that you can add in. Do the workings, bring your answers back to this. Now, working number 1, note number 1. Let's just go through this just to reiterate this. So the AEA and capital losses have been applied against the gain on the sale of the painting, as it will be taxed at the highest rate. Okay. She can have bad relief because we discussed the fact that she owns more than 5%. She has been an employee and she has been there for more than 2 years. Note 2. We've already calculated that. That's the balance of the basic rate band. Now, because the capital gain here is deemed to use up the basic rate band and it is taxed first, it will be taxed at 10%, obviously, because it's the relief. But it says there, her rate band is unused, deemed to be utilised by the gains qualifying for bad relief, and therefore pushes all the taxable gain for the painting into the 20% band. And then we've shown here what she's got left after she's made that claim. So the tax, the 450, so this is the bad relief, and this is the others, which will be taxed at 20%, giving us capital gains tax at 57,500. So if you get a question like this one, where you've got assets that do qualify and assets that don't qualify, make sure you put them in separate columns and follow the pro forma down. Show all the rules that you've dealt with throughout that question. Now, investors' relief is also a tax rate reducer, and it's an extension of the BAD relief. And it's available to investors in trading companies which are not listed on the stock exchange, so unquoted companies. We have a £10 million lifetime limit and everything's taxed at 10%. So it's quite an extension to the BAD relief, quite an extension. Rules and conditions. The qualifying shares must have been subscribed for on or after that date and held for a minimum of 3 years from the 6th of April 2016. There is no minimum level of subscription required, and you must not have been an employee or a director. If you're an employee or a director, it doesn't count. You must not. It's basically about investing in a business. So we have example number 3 here. On the 20th of October 2022, Ashley sold 30,000 shares in Toon Limited, an unquoted trading company, for £375,000, net of selling expenses of £10,000. Toon has an issue of 1 million ordinary shares, which have been subscribed for at par for £1 by the existing shareholders in September 17, and Ashley had subscribed for 40,000 of those shares. Thankfully, never worked there. So this is our proceeds. We can then work out the cost. Okay, we'll be able to work out the cost of those. Ashley has a taxable income of 60,000. Okay, so he is high rate and made other assets disposals gains of 7,000. What is his liability to tax? And again, you note that in the model answer, the rules have been written out. Ashley fulfills all the conditions. Therefore, the gain on the disposal of the shares will qualify for investors' relief. Okay, fulfills all the conditions, qualifies for investors' relief because they were subscribed for after that date. They've been held for 3 years. It's unquoted, and Ashley has never worked there. Put the rule down on paper. Write it out. Don't just do it. I know that this is right, therefore I am going to do the calculations and ignore the words. Words are still important in this tax exam. It's not just about numbers. So we have proceeds of 375,000. Now, the original shares cost £40,000. We haven't sold all of them. We've only sold 30,000 of those 40,000 shares. So this here is the proportion of the cost. Okay, now part disposal, yes, but with shares, this is a simple calculation. If you're not given the value of what's left, don't worry about that, because if they haven't, then just do whatever your numbers you've got. Use your common sense. Had 40,000, they cost £40,000. I've sold 30,000, therefore that must be the cost. Now, the AEA. Now, here what's happened is, in this answer, we've done a kind of marginal workings rather than writing everything out in full. So a marginal working, this is what I would call a marginal working. If you're not happy with that and you feel the need to put the 7 in, so the other gains would be 7. We would have taken that off there to do 0. If you feel the need to write it out like that because it follows logically in your brain, then do it that way. If you feel you can progress a little bit further and you can do a marginal working, as long as you clearly show what you've done. So here, the AEA of 12,300, firstly used against the other gains, okay, as they would have been taxed at 20%, leaving just that amount to go in there. Because we want to wipe this other gain out, simply because it will be taxed at the highest rate. So only the balance goes in there, and then that is the gain, 339,700, taxed at 10%, gives us 33,970.